It's good to have you this morning. It's a great day, and investing is what it's all about. Let me throw out there for you our disclaimers because the markets have risk, and our legal department likes to make sure that you're aware of the risk. And so that's what I'm going to do real quickly here. First disclaimer is this right here. Let me make sure I'm sharing that with you. You can tell my skill set on sharing screens is not the greatest. Can you see the disclaimer there? I just want you to know that as curious investors, there are risks out there. And if you desire to remain unidentified for the recording that's going on, please take your name and face off the screen. However, our back office gurus, i.e. Amanda, tells me that your name won't show up anyway. But just to be careful, be sure to take your name off there if you don't want to be world famous on this video. We don't have any crystal balls. This information that you're going to see here is not any specific advice or recommendations for any of you. You need to do your own research. Any forecast that we set forth here can't guarantee the future because nobody knows the future. Actually, nobody really even knows the past. It's only a definition of what somebody else has told you, but that's a separate discussion. Securities are offered through LPL Financial, a member of FINRA and SIPC. Investment advice is offered through Kimball Financial, a registered investment advisor, and a separate entity from LPL Financial. There you got it. We have got the disclaimers behind us, and now we can jump on to some important ideas. Last week, we talked about the first three stocks I invested in, and those three stocks included International Business Machines, Kimball International, and the third one was NiSource, Northern Indiana Public Service was the name of that company. If you're a beginning investor, I would tell you, let's start, and I'm talking about investing in stocks. There's a lot of ways you can invest, but investing specifically in stocks, I think what you want to do is start small. The broker that gave me the recommendation for those three stocks in 1979 when I had just turned 18 kept it simple for me. Three stocks for the amount of money I had to invest. And so that's what I would say. If you're a curious new investor, start with 2 or 3 stocks. You don't need any more than that to begin your learning process. The benefit of 3 stocks is you can learn about those. And the goal of owning stocks is to make a profit, and ideally to make a profit better than you could have done than having your money situated in a risk-free situation like in a savings account or something. So you have to have a minimum level to determine whether your time is worth your energy, and then a goal, a percentage you're shooting for. And so the minimum today is less than 1% is what the guaranteed rates are for savings accounts and investments like that. So your bar of what you're trying to beat is very small. There's a thing called inflation out there. That's the rate that the cost of goods and services are going up, and that looks to be between 2.5%, 3.5% today. It may be a little higher. So maybe today inflation would be your goal, because you're not even keeping up with inflation in your savings account. So using your base level to give you an indication of what you're doing is what you want to do. And inflation is the base level. I think that makes sense. So try to exceed the 2.5 to 3.5 would make it worth risking today. And how much then should you invest is the next question. Let me work backwards on the very basic mathematical situation for you. Let me look at my screens here to find out which one of these documents I'd like to work through. Let's start with giving you a real basic introduction on why you need to start with how much you're willing to risk. There's any number of things you can do with your money and take risk, but to understand risk is starting from a very mathematical basis. So hopefully you can see this screen here before you that just basically says the gains necessary to break even on an investment. And the starting off with how much are you willing to risk or how much you're willing to lose, a 5% loss, if you realize a 5% loss, it only requires about a 5.25% gain to get that principal back. And that's more often than not going to be easier for you investors to do that. Then as you increase that risk and allow a stock to drop 10%, it requires a little over an 11% gain to break even. 15% jumps up a little over 17%. And then you can see how, as you allow losses to get bigger, the inverse side of that has a geometric or an increasingly difficult way of breaking even. And so you want to start off by limiting how much downside risk you have on your portfolio so you can find a variety of options to get back to even. And then ultimately what you want to do is make a profit, but it's not realistic to think you're going to be right on all your investments. And so what you want to do is minimize the loss on those where you've made a bad decision and the market's going against you. So that's the very basic math on that decision. And that one is good to remember for you. All right. So let's work through then how much we're going to make put to risk and how that works out. So let me grab another number for you here. Let's pick a dollar amount you're willing to risk. And on this one, we're going to risk $500. First, you want to do is decide how much money you're willing to lose, because we're going to start with a defensive approach before we spend too much time. We'll talk about offensive. So we're determining how much we want to invest by starting by how much we're willing to lose. With that, then you calculate the percentage you'll allow your mistake to go downward before you correct that percentage. And then it's a basic math calculation. So how much you need to invest determines how much you're going to lose. And on this example I picked, let's pick a $500 loss and look at the various percentage of how much money we can invest based on what we're willing to allow the investments to drop in value. So if you're only going to allow your losses to go to 5%, you can start off with $10,000 and have $500 at risk. If you say, I'm going to give myself 10% downside risk, then you're going to have to cut that in half and you'll have $5,000 to invest. And then the same thing, if you're going to allow 15% risk to your portfolio and you're going to allow $500 downside risk, then you can only put $3,300 into the markets. So thinking about it that way, then you have to choose how much you want to risk, and then why would you allow a loss to grow more than 5, 10, 15%. You definitely don't ever want to, I don't think, let a loss get to that 15% level, because then you're going to have a hard time recuperating from that level. So let's now go back and check out some stocks and see how that might have worked. Any questions yet at this point in time? Anybody have any questions out there? Okay, I'll move forward then. Here is one of the first stocks I bought, and it's International Business Machines. Back in the 1970s when I bought this, it would have been similar to buying something with a name like Apple or Google in the perception of the people back then. I'm going to change the date on this and go back to 1980. I know that's ancient, but that's where we're at on this thing. So here's 1980. I'm looking at this on a daily basis here. Um, I would have most likely bought this stock somewhere around right here, around $70 a share. And, you know, it would have probably stopped me out right around the 65 level with a 5% loss. And I would have ended up getting out down here at this 62 level of range at a 10% loss. And at 70, 15%, uh, um, I might not have got stopped out here, but I would have, you know, held the stock from here all the way to over here somewhere before I got stopped out. And I would have ended up losing 15% over here and just had a horrible ride. So a 5% stop would have probably got me out right here, and I would have had my money and reevaluating how to invest that money. IBM was a great company during that time. It was prior to the invention of the PC and all the technologies that followed with the internet over the next few decades. Let's look at this on a monthly basis. IBM came public here in 1962. The stock was priced at about $10 a share. Had you bought it then and held on to it for about 5 years, it went up sevenfold, up to about $75 a share. And then it traded sideways for the next decade. You know, it didn't do much of anything. And then if we move this forward to 1990, kind of get a feel for what it looked like. From when I bought it here in 1979, it went down for about 3 years and then it had a rally. I wasn't able to hold on to it that long because of college expenses and things like that. So it just didn't make any money while I owned that stock. It had a good spurt right here in 1981 to 1983 where you could have got into this stock around 50 and taken a profit had you had the wisdom of over $100 a share. And that's what we would like to find as we begin digging into stocks deeper, is to try to find that change in character where a stock like this one, if you say happen to buy it here and just drew a line across it, it was trending downward, and even at times even a more defined downward slope. So what you want to do is, if you find an older stock like that, look for a change in character where it starts to go up again. Let's move this forward and just see what would have happened. So it peaked out right over here at about, let me get the right thing here. It peaked out right here at 155 in 1987. And let's go ahead another decade, go to 2000. Went to 2020. That was, yeah, so it peaked out, what did I say before? 97, so 2010. Yeah, so it peaked out right here at about $130 a share back in the late 90s. And you can see that it, all the way through 2010, never hit that price again other than all the way out here. So it took a good 10 to 12 years for it to get out there. And then if we go bring it forward to today, at that 130 level, it rallied some more and got up over 200 in 2013, and now it's trending at about half that level at 122. So this stock had some good runs, but it wasn't something where you can just buy it and hold it and think that it was going to do a nice job for you forever. And that was pretty much a household name in the 1970s. So IBM would have been considered the bluest of blue chips, which in poker terms, blue chip used to be like the most valuable poker chip out there. And so that's what they would have called IBM back then. And then NI was another stock that I owned. And here's a long-term view of NiSource. It was called Northern Indiana Public Service back then. Utility stocks are known for paying dividends because they have a constant cash flow. The regulators tell them how much they can charge you and me for our rent, and consequently, or not our rent, but for our let me get, have I not been sharing? I'm sorry about that. Here's Northern Indiana Public Service. So it has gone sideways for a long time, from the 90s all the way over here to about 2014 before it broke even. And then the utility stocks, you can see this upward trend has been a safe place to invest until of late. It's just kind of flattened out there. The utilities, why people own them, again, is because you can get a dividend. That dividend is based on the rates they charge for your gas and electric. It used to be your phone was a utility. It's not so much a utility anymore. Your water company is a utility where people are paying in those constant payments on a monthly basis, and then they would turn around and pay that out to you as a shareholder as a form of income called a dividend. NiSource, I owned that for a while back in the 1970s and 80s. Let's go back here to 2000 and see if it shows us what happened with that. Yeah, so I bought it right around here in the, well, it's showing an $8 level there, and then it dropped all the way down here to $5.13, and you can see the trend. It kept dropping and dropping, and then by the late 80s it changed its character and started trending upward. And that's what I said earlier, is you ideally don't want to own stocks that are trending downward a lot so long, but you want to get that upward trend and lock in on those sorts of things. All right, Kimball International is my third stock that I own, KBAL. I bought this one in 1979, right around here. Needed that money in college, so I would have probably shortly after I bought it had this drop off right here. Let's see how much of a drop that was. It was about a 40% drop in price over there, and so that one, no doubt I rode that one down, I think, because I think I held that for at least a year or so. So my first three stocks didn't have any limitations on the downside risk, and this one I could have just waited probably until about 1982 to get into this one, and there would have been plenty of other stocks in the early 80s that were moving better than this. There was one I bought by accident during the 1980s called Coleco. Coleco came out with the first game board, and I should have probably kept attention to that theme over my lifetime, because games have been a really profitable thing, particularly electronic games. And Coleco, I think they came out with the Atom system or something, and that stock went from $10 to about 90. And I might have had 10 shares or 20 shares, and it did all that in a period of weeks. And I didn't understand the idea of taking profits, so some of the math that I pointed out to you earlier today, and let that drop all the way back below 10. So I got the benefit of going all the way up to 90 and all the way back down sometime here in the 1980s with that. And so as you're looking at how to invest your 2 or 3 stocks, there's plenty of options of companies, and there's no real time limit of how long you need to stay into those stocks. Let's just see again if there's any questions out there. Do any of you have any questions that you would like answered about the market right now or the stocks that are out there? Okay, let's just show up. Let's look at a couple more stocks today, and then we'll wrap this up. But we talked earlier about probably 2 or 3 stocks is the right number. How much dollar amount you want to risk is the proper thing, and then by dividing what you're going to allow your risk level by the percentage you're going to allow stocks to drop, that'll tell you how much money you can invest and put at risk and safely stay within those parameters. You don't ever want to leave your investment to full risk. You know, if you put $10,000 at risk, you don't want to allow it to go to zero. You want to stop that as soon as possible. And so there's plenty of stocks that would give you a feeling for that. Let's look at this one real quick. This was go to today. This is the company Axum Enterprises that came out with the original Taser gun, and it came out, let's see here. It came out in the early 2000s. So, you know, we'll get into more technicals of this, but this stock, once it came out and settled down, it went from, looks like about, say, 50 cents a share all the way in a few months to over $33 a share. And most likely, had we been talking about this and you're wanting to get into it, we would have bought in over here at this $2, $3 level. So even if you bought it at $2 or $3 and you happen to get out somewhere around 30, that's a pretty good rate of return. But then if you didn't get out of this stock and it came rushing down, say you got in at, maybe you didn't even get in until over here at 5 or 6, well, it came all the way back down right here to $5.30. So you could have, that's what I was saying, is the risk of not having limitations and not paying attention to what your stock's doing is it can go straight up like that and come straight back down. And the successful stocks like the Coleco that I owned will tend to go up and come back down at a very similar angle. See how that angle goes there? That's not unusual. I think another stock that did something like that is Crocs. See how this angle went up right there, and it even came down at a steeper angle. This one did something unusual. It gave investors a chance to ride it back up a little bit, and that slope was a little bit lower. It's not too much off, but it's the same kind of slope. And then this thing, it struggled for 7 years where it just kept draining down. And those of us that wear Crocs, we can probably understand from those cool folks that are watching that don't wear Crocs why it probably did this. They were a fad, and that's what shot them up there. And then once the fad ended, they almost went out of business over here in 2009. And so if you're going to look for, you know, fast-moving stocks like something like a Crocs or an Axum or a Coleco, you have to realize that if you should hit one of those and have luck with it shooting up like a rocket, you need to have some principles to start taking profits along the way, because that slope of ascent and the slope of decline is a repetitive nature of stocks that are successful stocks in the short term. And that's the sort of stock you might want to have 1 or 2 of your 3 stocks in. However, you got to be very cautious with the risk level you're willing to take on those. I think we're about running out of time, so I'm going to wrap this up here. That the market is right now overall trending downward in the short term. Let me give you a quick picture of that. Go back to today. We're at today, and we're going to go to the NASDAQ, which is a broader picture of small and innovative companies. This is a monthly calendar or a chart of the stock, and you can see where this thing shot up in the late 90s, and people were making a lot of money. It went from this 1,300 level all the way to 5,100, and then didn't do anything for pretty much almost 2 decades, where this thing stayed below that 51 level. And that's why you have to have stops on your stocks. And then it began taking off again around 2016, and it has a great run with companies like Google, Amazon, Netflix, Apple, and such. And so the slope of that is even a little less significant than the slope back in the late 90s. But if you take this back to a daily chart, we had the March sell-off here, where investors who rode it all the way down had a difficult emotional time. And then we came out of that around the middle of April, and this thing started just rallying very nicely. This activity right here, where the stock has kind of taken a downward motion here, wouldn't be surprising to me if the NASDAQ didn't try to work its way back down to the 10,000 level, or even to this line right here. And so that's why today we're very cautious at jumping back into stocks. And so what you want to do as a curious investor is start putting together a list of names of stocks that you'd like to get into. Then as you look at that, what we'd like to see is those stocks that begin to get back over this red line, which is known as the 50-day moving average. And so Um, let's look at Apple real quick before I call it a day here. Apple had this great run from 53 to 100, and I don't know what that level is. Let's see here. 137 is a great run, but it's come down from 137 to down below this 50-day moving average, and it's trading at 107 today. What we'd like to see is it begin to kind of curve out and form like a rounded bottom like this did right over here. And so there's no urgency for anybody to put money in anything like Apple right now. You're going to have time to get into something like this, and so just be patient, and let's get back together here next week and talk about some good investments. So thanks for joining today, and I'll see you real soon.